Welcome back. You're watching Money, 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 and we are in conversation with Saurabh Mukherjee. And Saurabh is about to tell us a simple way of getting rich. Are you, Saurabh? Is there a shortcut to these things, perhaps?
I think the conventional view is everybody has to take a lot of risk to get rich in India. But my view has always been that the lower the risk you take, the more conservative your investments are. Provided you pick the right stocks and the right funds, you really have in India the unique combination, the low risk route to making stupendous amounts of money over a 10, 20, 30-year career.
That sounds too good to be true, you know. And they say, I mean, is it even possible if something sounds too good to be true? Does it even exist?
I think there are two parts to it. I think everybody, whenever I say these things and whenever I write these things, I get exactly the skepticism. There's two parts to it. One is you obviously have to pick the right stocks. The other part is keeping fees and expenses low. I think investing, everybody gets lost in this chase for the next multi-bagger. But if you keep your costs and your fees and your brokerage fees and your fund manager fees low, that's the other half of becoming stupendously rich. And if you can combine these two, you're well on your way to serious wealth.
Okay, so, you know, I'm going to take a couple of steps back now, since we are actually talking about regular middle-class sort of, earner. The question that I always get asked as well is that, you know, how much to set aside?
Sure.
There is definitely the inflation factor that you have to consider.
Absolutely.
But sometimes you wonder, I mean, these numbers that are thrown at you, X crore, you know, X, Y, Z crores that you need to have in your bank, are the calculations correct? Whom to believe? How to really set aside the goal?
So there are two parts to planning your goal. One is just to hedge inflation. You need returns of 9-10% just to deal with inflation. Over and above that, if you're saving for your children's education, you're saving for retirement, you're saving for, say, a holiday home in Goa, you're looking at an extra over and above the rate of inflation. So if 10%, 9-10% is pre-tax is what you need to deal with inflation, typically most people need somewhere around 15 to 17% over 20-30 years to save for broader goals beyond just hedging inflation.
But for the average Joe who's thinking fixed deposits, mutual funds, now of course a lot of Indians through SIPs are in that side of the investment sort of arena, where will you achieve that 15 to 17%?
For most people, if they're able to take, say, 100 rupees of their wealth, I think there's sort of an 80-20 demarcation. 80 rupees equities, 20 rupees as a rainy day asset, which goes into liquid funds and bond funds. You want to keep your rainy day asset very liquid, very safe. The 80 rupees that you put into equities, I would say there's three buckets to it. One, I would begin by saying something which sounds very counterintuitive, but I think has made a lot of sense for me, is a tracker fund. Put your out of 100 rupees, put 30 rupees in a high quality Nifty tracker fund, which charges you, say, 0.1% and diligently tracks the Nifty.
So an ETF, simple ETF,
absolutely,
which doesn't cost too much.
And there are several houses in India which offer ETFs. Log on online, buy your ETF. You probably have to open a demat account, but it's not that big a deal. So buy yourself an ETF for 30 rupees of your money. With the next 30 rupees, what you need is a blue chip stock portfolio, high quality stock portfolio. 20 rupees out of 100, I would say find a small cap mutual fund. The good news in India is there are several small cap mutual fund managers who have consistently delivered super returns, right? And we are blessed as a country, both in PMS and in mutual fund. We've got talented small cap managers. So 30 rupees tracker, 30 rupees coffee can, 20 rupees in a small cap mutual fund, and the final 20 rupees your rainy day corpus, government bonds and liquid funds.
This is really interesting because nowhere in this do I hear assets like real estate, or gold. I don't think you have much love lost for real estate, right? Which traditionally has seen Indians.
I think, as you said earlier in the program, I'm a numbers-driven geek. So, for example, the suburb of Bombay we are standing in, most of these flats around us are $1 million plus, right? And that to me is a little, surreal. The rental yields on these flats are 2%. The cost of buying taking a home loan in India is 8.5%. If you have that sort of mismatch, it's telling you that these flats in India or in Mumbai are overvalued, right? To put it in a perspective, my parents in the suburbs of London, their house in the suburbs of London is cheaper than my flat in the suburbs of Bombay. And I think we can take a broad guess as to which city has more money. So I think residential real estate in India has got mispriced. If you buy a flat to live in, it's one thing. But you've got to be clear that it's not going to make you a great deal of money over the next 10 years. If you take countries like USA, take countries like UK, Australia, over the last 100 years, in the heydays of the West, real estate has given anywhere between 0.5% to 1.5% per annum. right? If real estate hasn't worked as an asset elsewhere in the world over long periods of time, it's unlikely in India we'll reinvent the wheel and give tremendous returns from real estate over long periods of time. 03 to 13, we had a tremendous run. A lot of black money, as I say in the book, went into real estate. I think that era of black money fueling real estate prices are broadly behind us. Savings are swinging into the financial system, and they're coming into assets like mutual funds and coffee can portfolios. And hence, in a way, the context of modern day savings has to focus on financial rather than physical.
Now, before we end this part of the conversation, I'm going to come back to mutual funds. And you made some points there earlier about, who gets commissions where and what's happening. We discussed why maybe exchange traded funds like a Nifty fund might be a smarter idea. How should one build their mutual fund portfolio aside of the stock portfolio, which we'll discuss in a bit?
Out of, say, the 100 large cap equity mutual funds we have in India, all the data suggests that no more than 4 or 5% of them have any ability to generate consistent alpha. That means 95-96% of our large cap mutual funds have a pretty patchy track record of alpha generation, and yet they're taking away 2% from you every year. Which is why my point is on large cap mutual funds, rather than buying beyond this 4 or 5 very elite select fund managers, you're better off buying an ETF, right? Okay. In small cap mutual funds, on the other hand, I think there's at least half a dozen funds who regularly, year after year over the last 10 years, beating the indices. And whilst they charge 2.5%, they're giving you your money's worth.
One final point on commissions, because the model is really evolving, and I think a lot of investors still don't know whether it's a distribution model they're following, whether there's a trail commission element to it. In your experience and what you see around the industry, if one is willing to pay the price for fair advice and get away from this distribution commission model, then what is a reasonable price to pay for advice, and what is the industry parlance?
I think the good news is, because of the regulated investment advisor construct that SEBI is trying to come up with, there is a growing group of advisors who are paid by the customer vis-a-vis fees. And by and large, the number that's doing the rounds is the RIA is taking 1%. Is taking 1% of your portfolio as fees. But the comfort you have is that 1% is transparent, and the RIA's interests are aligned to your outcomes.
All right, on that note, we're going to take another quick break. But on the other side, we get down to doing what Saurabh does best. Yes, talking stock picking really. How to create your own portfolio. If you're willing to go beyond mutual funds, how do you approach the world of equities?